people may not be prepared to hear what we're about to expose in this video, but we need to talk about it before the situation gets out of control. Conditions are changing rapidly for banks, and this will have a major impact on everyone's lives over the next few months. A credit crisis is already in motion in 2023, and it's threatening to collapse the standard of living of many American families as loan conditions get tighter while the cost of living continues to climb. Access to credit is about to become an enormous issue for U.S. consumers, and experts say this is looking a lot like the financial meltdown we witnessed 15 years ago. The recession that threw millions out of work and destroyed nest eggs in 2008 also caused the worst credit crunch in history. At that time, many people were forced into insolvency and foreclosure, unable to pay their loan obligations or provide for their families. Between 2013 to 2019, consumer debt leveled as the economy began to recover. However, the pandemic threw sand into the economy's gears and led Americans to rely more on their credit cards to be able to get by. Today, we're carrying far more debt than ever before, and the risk of widespread failures in the banking system is much higher. So, financial institutions are far more careful about who they are going to lend money to. Bank loans allow us to buy homes and cars, to send our children to college, and to have things in the present that we can pay for in the future. The capitalist model was entirely built on the extension of credit and the ensuing debt it creates. That's why, for decades, the U.S. consumer culture of buy first, pay later has been helping households to ward off immediate expenditure. But at the same time, it has been increasing the debt burden to record levels year after year. Now, a combination of persistent inflation and soaring interest rates is further stretching consumers' budgets, and data shows that most households are reaching a breaking point. Last month, Americans' debt levels just hit a new but undesirable milestone. For the first time ever, credit card debt has surpassed $1 trillion. And that's according to the Federal Reserve Bank of New York. In the second quarter, credit card balances skyrocketed by $45 billion, or almost 5%, to land at $1.03 trillion. That's more than triple the average amount of new debt households have taken on in that period since after the Great Recession, the Fed's latest quarterly report on household debt and credit revealed. Not only credit cards, but also auto loans and mortgages drove the overall household debt level to $17.06 trillion, the report showed. That's a nearly 15% increase from pre-pandemic levels, meaning that we've taken about $1 trillion more debt every year for 3 consecutive years. This has happened because the cost of living has risen 4 times faster than income since 2020. For the past 2.5 years, we've been spending more to consume less each month. For households earning the median income or less, which represents about half of the population, turning to credit has become the only option they have to afford basic expenses. From July 2022 to July 2023, total credit card debt grew by 8%, going up for 5 consecutive quarters, and increasing at some of the largest rates in 20 years, according to Wallet Hub, a personal finance website. Unfortunately, it's only gonna go up from here, says Matt Schultz, Chief Credit Analyst for LendingTree. What's driving it is inflation, high interest rates, and just generally how expensive life is in 2023. The firm estimates that the average household's credit card debt stands at $10,170. These numbers reflect that Americans are deeply hurting financially, as noted by Mark Wittner, a chief economist with Piedmont Crescent Capital and a former senior economist with Wells Fargo Securities. The expert highlights that higher interest rates are further complicating the outlook. Until March 2022, the benchmark U.S. interest rate was a little above zero. Then, the Federal Reserve began the most aggressive quantitative tightening cycle on record. Interest rates are now in a range of 5.25% to 5.50%. That's the highest they've been in more than 20 years. As interest rates feed through from the federal funds rate to interest rates on mortgages and credit cards, that affects everyday consumers. Sophia Paik, an economist at decision intelligence company Morning Consult, explained during an interview with CNN. So, with elevated interest rates, paying that debt becomes more expensive. And with consumers continuing to take on more debt, this combination will put more pressure on some households who have those tighter budgets, she said. In other words, the Fed's policies are allowing credit card companies to charge high interest rates, making balances even tougher to pay off. At the moment, credit card interest rates are at a staggering 20.6%. That is the highest since data started being tracked in 1994. Bankrate.com analyst Greg McBride stresses that people aren't financing purchases at 20% because everything is going swimmingly. They're doing so because they are under financial strain. People's budgets are really tight. If rates tick up again, we just don't know what that's going to look like. That's particularly concerning, considering that 55% of cardholders carry a balance from month to month. With double-digit interest rates, credit may no longer help consumers to remain financially sound, but actually have the opposite effect and bury them deeper into debt. In fact, a poll conducted by Redfield and Wilton Strategies found that 74% of Americans are concerned about their ability to pay off their credit card debt this year. On the flip side, several people are already coming up with a plan B to get out of debt, but that may be straining their funds. Last week, Bank of America reported that more people are tapping their 401k accounts because of financial distress. The number of people who made a hardship withdrawal during the second quarter surged by 36% compared to the first 3 months of the year. Almost 2/3 of consumers are already worried about access to credit amid the spike in interest rates and tighter standards at banks, according to the New York Fed's survey of consumer expectations. The number of people indicating that the ability to get loans, credit cards, and mortgages is harder now than it was a year ago rose to more than 60%, the highest level in a data series that goes back to June 2013. Fears of credit access have been rising steadily over the past 12 months, especially among low-income Americans and small businesses. On the other hand, a major red flag for banks is the steep rise in debt delinquency in recent months. The number of individuals delaying their debt repayments more than doubled since 2019, Bankrate reported. This year, the share of debt turning delinquent, that is loans not paid for over 30 days, jumped for all loan types, including credit cards. The number of accounts past due by one cycle has increased 42.6% over the last 2 years. Meanwhile, delinquencies have crept up to the highest level since 2017. The surge in the number of delinquent accounts is clear evidence that borrowers are already having a hard time keeping up with credit card payments. Government data exposes that the transition rates into early delinquency for credit cards, auto loans, and home mortgages increased again in quarter 2. Mortgage delinquency rates are reaching levels last seen before the housing bubble burst in 2008. Likewise, the moving averages for auto and credit card delinquencies are the highest since the first quarter of 2018 and the first quarter of 2012, respectively. However, Going out of debt and having a good credit score is arguably more important right now than at any point during the past few years. That's because it's been getting a lot harder for the average person to take out a loan or get approved for a credit card as banks and other financial institutions continue to tighten their lending standards. They are outright rejecting applicants, raising minimum credit score requirements, charging more interest, and lowering credit limits. Back in the spring, after the collapse of several major banks, several financial analysts sounded the alarm over a so-called credit crunch, a term used to describe the economy when consumers and businesses can no longer get access to the loans they need. Over the second quarter, significant net shares of banks reported having tightened standards for credit card loans and other consumer loans, the Fed report reads. Numbers from the U.S. Central Bank show the trend from a different angle. By the end of June, the rejection rate for all types of loans, including credit cards, mortgages, and auto loans, had jumped to nearly 22%, the highest point in 5 years and one of the highest readings since the survey started in 2013. Because of inflation-busting interest rate hikes and mismanagement in the banking system, the industry has less money to dole out, highlights Randall Watzek, a financial advisor at Raymond James. When you have less money, you focus on the highest quality people you can find with the limited amount of resources you have, he explained. For instance, banks are now asking you to verify more financial information than they normally would have, especially related to income. That is making it particularly difficult for gig workers and small business owners to get loans, given that their earnings come from self-employment. It's one of the paradoxes of life, Watzek says. The people who need money the most won't get it, and the people who don't need the money, that's who the banks want to give it to. He's referring to those with the best credit histories. According to credit scoring firm FICO, a credit score between 670 to 739 is considered good. An excellent credit score is between 740 to 799, and an exceptional score is above 800. Put simply, lenders are a lot less likely to do business with people who have scores under 670, which account for about 35% of the population. Earlier this month, major credit card issuers such as Visa and MasterCard announced that fee hikes are coming in October. Since the turn of the century, credit has never been so expensive. So if you could possibly get out of debt and avoid using your credit card during the current economic downturn, that will help you from falling into a debt spiral later on. The ongoing credit crunch will financially strangle many borrowers who are carrying high levels of debt, and if you're one of them, seek professional help to see how you can restore your financial health. Unfortunately, our population has never been taught about how to manage their money, and many people get in financial trouble because they do not understand the consequences of racking up debt. And once you get in trouble, it can take many years to get out of it, and it can affect every aspect of your life. Now is the time to batten down the hatches and prepare for the stressful years ahead. Banks are in danger. The financial system is being shaken. The Fed will not bail us out anymore. So the potential for disaster is very real, and the longer we wait, the bigger the problem becomes.